Are you aware of the debate about using life insurance as a retirement tool? Just like any investment or financial tools, when used in the proper way, it can be a very beneficial thing for you. However, to the same argument, when things are sold for the sake of commission, it may not be structured in a way for you to win, and this is where the debate sits. So when and how should you use life insurance as an investment tool, and when should you avoid it at all cost? Hi, I'm Jackie. I help make Canadian business owners' goals a reality with innovative financial advice. Let's dive in and I'll share with you the key things to consider when using life insurance as part of your financial plan. The very first question you should ask is, why is life insurance a good investment? Not all life insurance can be considered an investment in your future beyond protection for your family if something were to happen to you. Term life insurance is not an investment because there's no cash value built in the policy, and this is why the cost is less. If you're in the market for life insurance to cover short-term debts, or if you're looking for purely just insurance, then term life insurance is the best place for you to start. Insurance is an investment when it is a permanent policy, which is primarily whole life participating insurance and universal life insurance. The biggest difference between universal life and participating whole life is how the investment is managed. If you choose the universal life insurance route, there are a lot of funds to choose from and you can have a pretty diversified portfolio. But it does require you to do some work. I wouldn't just rely on the advisors to remind you to rebalance your portfolio or adjust it. You really should be interested in managing it yourself. The biggest benefit with universal life insurance portfolio investment is the fact that it grows tax-free. The tax deferral tool is great if you had some non-registered funds that you plan to invest for the long term anyways. The life insurance portion will solve the estate taxes, and all the funds will eventually go to your family tax-free. Whole life insurance, on the other hand, is fully managed by the insurance company. Honestly, it's not that different with a whole life insurance. Inside a participating whole life, there is an account called a PAR account. Imagine the PAR account just like the bank. Your insurance premiums, aka the money you put in your insurance, goes into the PAR account, and the insurance company takes that money to pay out the claims that year, cover the cost of administration, and the remaining funds would be invested. The investment is a diverse portfolio of stocks, bonds, private loans, government loans, and real estate investments. The biggest difference is that because you are partial owner of this PAR account, you'll get the returns instead. The reason why the risk on the PAR account is low is because typically the insurance company is investing in low risk investments, such as loans to large businesses or governments. Real estate is also a big portion of its portfolio as well. Additionally, insurance companies learn to smooth the returns, meaning they will take a reserve when they hit phenomenal years to offset the bad years. Because of this, these PAR accounts would have a standard deviation of less than 1%, which means the investment only goes up or down by 1% on average per year, and it wouldn't have big swings like the stock market. This is safer than the standard GICs you see at the banks. Whole life is a great investment tool when the goal isn't to get a killer return, but instead a hands-off approach that is steady and stable in the long term. Now that you've established that permanent insurance is a great tax savings investment and has great investment options for whether or not you want to manage it yourself or let the insurance company manage it for you, how do you actually take advantage of this and use it for yourself rather than just a tool to protect the future of your family? There are 3 ways to access the money in these insurance policies. Now I'll share with you when and how to use these methods. The first method is to access the funds via direct withdrawal. This action will trigger a taxable event. The income taxes is calculated on the prorated basis based on your adjusted cost base, or the ACB. Think of this as the total premiums you paid into the policy. So for simplicity, let's say the total value of the policy is $100,000 and the ACB is $50,000, and you requested for $10,000 withdrawal. Then you can expect 50% would be a taxable, and the other 50% would be from the ACB, which is not taxable. This method, although is not very tax efficient, it is quick. When the ACB is high, which is usually in the early years of the policy, then it can be a source of fast funds when you're in a pinch. I personally have done this. In my early days of my career, I was hustling and working very hard and busy spending money that I didn't pay attention to my taxes. When tax time came along, I was slapped with a very large tax bill that left me with very little funds in my account, and it was the exact same time when I was closing my first property. Obviously, at the time, I wasn't a very good financial planner myself. I had to take some funds out of my policy to close on my first property. It was the best decision I made because it started me on the real estate journey and taught me some valuable lessons on taxation and planning. I would say if I didn't make those mistakes then, I wouldn't be who I am today because I wouldn't appreciate the benefits of planning and understanding taxation. The second method to access funds of your life insurance is with a policy loan. A policy loan is borrowing the funds out of your policy with the same insurance company. Since the asset is already with them, the loan approval process is super quick. Generally, it's pretty much a request to an insurance company and the funds will be available within the week. Policy loans typically have a higher interest rate than the prime rate. It is normally pretty close to that of an unsecured line of credit at the bank. In today's standard, that could look like 7 to 8%, but I suspect that will go up by 1% in the near future with all this interest rate hike changes. The benefit of a policy loan is that your investment stays intact and continues to grow since you didn't actually withdraw from the account. And the loan itself is not a taxable income to you. You just pay the interest rate. One thing a policy loan does impact is the ACB of the policy. Policy loans reduces the ACB, which ultimately means you could be taxed more if you ever do a withdrawal or a cancellation. This is a great option if you need the funds quick, but you want to avoid the taxation today. The final method is to access the funds with a collateral loan. The difference between a collateral loan versus a policy loan is who is lending you the money. In a collateral loan, you're assigning the policy as collateral to the banks and they lend you more on a favorable interest rate than the policy loans. It does require financial underwriting because of this. You will take a hit on your credit, but usually we see interest rates closer to prime or prime plus 0.5%, which means it is cheaper than a policy loan. The loan is quite customizable too. You can capitalize the interest rate, which means you can add it to the loan balance, or you can pay the interest yourself. It works a lot like a revolving line of credit. You can pay down as much as you want. Since you haven't taken out the funds from the investment, it will also continue to grow and you'll have more room to borrow from. A big difference between a collateral loan versus a policy loan is that the loan is separate to the policy, so the loan does not impact the ACB. The best ways to use a collateral loan is either to invest it or use it as a retirement fund. If you borrow from it for investment purposes, meaning you want to fund the investment in real estate, investments, or other businesses, then I would pay the interest out of the pocket. The reason for this is because all those investments will allow the interest to be tax deductible. Whereas if you're going to wait until retirement to enjoy these funds, then you'll want to capitalize on the interest. Add it back to the loan balance. You really don't want to remember to make monthly payments for your interest when you're not actively earning income, and instead just enjoy the funds. Obviously, you run the risk of running out of money with the second method. However, because you're borrowing later, so the cash value would have grown as long as the interest you are capitalizing is less than the dividends generated from the bigger cash value, then you'll be okay. All financial tools have their risks and benefits. Take time to understand them, and if it doesn't solve any problems that you have, then I wouldn't recommend it. Always put your goals first instead of chasing a return or a deal. Thank you for watching. If you're feeling stuck and want unbiased financial advice explained in ways you can easily understand, book a call with the link in the description down below.